Okay. And I guess you go a little bit deeper to this in your separate video, Countdown to Crisis, where you talk about how this crash is going to be fast, bloody, and unavoidable. There's a
Right.
link below, londonreal.tv/Jim. You also talk about position yourself to profit for this crash in 2022. Do you want to give us any hint about how that's right in front of our face, or should they go watch the
Well,
video for that?
well, I can give you more than a hint. Like I said, these things they're often presented technically because some expert wants to seem smart or whatever, but you can do it in plain English. So basically, what we're talking about, the warning signal, and it's a bright red flashing light, is an inverted yield curve. So what does a normal yield curve look like? So the x-axis is time, and the y-axis is interest rate. So, and treasury market's a good example, but there are other markets. I'll get to one in a second. So what are the maturities of treasury? Well, it's 30-day bill, 60-day bill, 90-day bill, 1-year bill, or 360-day bill, 2-year note, 5-year note, 7-year note, 10-year note, 30-year bond. So that's your x-axis. And interest rates they can be negative, but kind of 0 to whatever. A normal yield curve is upward sloping. The longer the maturity, the higher there. And that makes perfect sense. If I'm going to lend you money overnight, I might want a certain interest rate. But if I'm going to lend you money for 10 years, I might say, hey, Brian, you got to pay me a little more because, I'm taking more risk, et cetera. Perfectly normal upward sloping yield curve. And whether it's steep or flatter, okay, that's important if you're a trader, but upward sloping. But an inverted yield curve is downward sloping. An inverted yield curve says future interest rates are going to be lower than present interest rates. Well, why would that be? If I'm lending you money for a longer period of time and I want a risk premium and protect myself, why would I take a lower rate? The answer is because I think really bad things are going to happen. And I don't mean me personally. I mean, this is the institutional market. So, and we see this in the treasury market. It flips around day to day, but right now you have an inversion in kind of 2 years to 5 years. So a 5-year note is yield to maturity is lower than a 2-year note. And you see it in 7s to 10. So the 10-year note has a lower yield to maturity than the 7-year note. It's not that the whole curve's inverted, but it's in sections. It is. So at the short end of the curve, 30, 60, 90 days, 1 year, yeah, it goes up. Well, that's because the Fed controls that part of the curve. They already told us what they're doing. We know they're going to raise 75 basis points in July, at least 50 in September. We'll see what happens in November. And then they have another meeting in December. But there's no reason to think the Fed is not going to remain on this path of 50 to 75 basis point interest rate hikes for the remainder of the year, which is going to get interest rates of 4%. I remember when they did this from 2015 to 2018, late December 2018, they went from 0 to 2.5, 2.25, 2.5 range. Now you're talking about going from 0 to almost 4 in 9 months. That took 4 years, from 2015 to 2018. So 4 years to get 2.5. Now you're talking about 8 months or 9 months to go to 0 to 4. That's Volcker territory. So yeah, so the short end of the yield curve is upward sloping, as you would expect. But you get out around not even that far. I used to have to say 3 years, but now like 2 years, it goes down again. Well, this is the biggest money in the world. Treasury market is the U.S. Treasury market is the largest securities market in the world. It's the big money, the institutions, sovereign wealth funds. Yeah, retail can play, but they're not a big factor. And they're telling you that things are going to get worse. Now, just to pile on, as we say in American football, there's another market that's even more powerful, more sophisticated, insiders only, the big money runs the world, and that's the Eurodollar futures market, traded on the CME. So what's a Eurodollar? Well, these are dollar-denominated loans that banks make to each other, usually on an overnight basis, sometimes longer. This is how the financial system is really funded. Forget the Fed. The Fed's kind of a sideshow. It's good for headlines. The Eurodollar market runs the world. So when Deutsche Bank needs a little money and they borrow from JP Morgan, or Citi lends to Credit Suisse, or however, UBS, UniCredit, however it plays out, that's all in the Eurodollar market. But the rates are very short term, overnight, 1 week, et cetera. But that's what banks use to leverage their balance sheet. That's what banks use to support their derivatives positions. That's what banks use for collateral. And if I'm going to have a derivatives position, I have to give you collateral. And this symptom of a liquidity crisis is when you say, yeah, okay, Jim, I'll take the collateral, but I only want treasury bills. I don't want your junky mortgages. I don't want your corporates. If you give me a 10-year note, I'm going to give you a 1-point haircut, which is a lot. I want 30-day bill. I want your best, absolute best collateral. And even then, there's a little bit of a haircut. So if I have to get that collateral to pledge to you to leverage my balance sheet so I can make money, I need dollars. If I'm Deutsche Bank, I need dollars to buy treasury bills. Can't buy them with euros. And this is the secret of why the dollar is so strong. Everyone's like, wait a second, you guys got, multi-trillion-dollar deficits. You got 130% debt to GDP ratio, which is about as high, almost as high as Lebanon. Your budget's out of control. Your inflation's out of control. Your politics are dysfunctional. Everything's bad. Why on earth would the dollar be so strong? The answer is behind the curtain, people need dollars to buy dollar-denominated collateral to support their balance sheet. So that's the secret driver there. Now, what's going on with the Eurodollar futures curve? Now, you can trade Eurodollar futures on the CME, and they go out, I think they might go out to like 8 or 9 years or 10 years. But most of the liquidity obviously is in the early months. But the 2 and 3 year, 4 year futures trading is relatively liquid. Certainly 2 years is very liquid. And they settle monthly, and then as you get to long maturities, quarterly, et cetera. So there's the Eurodollar futures curve. Now, how to think about this? And this is interesting. These are long-term bets on short-term rates, right? Because if I buy a Eurodollar futures 2 years forward, I'm making a 2-year forward bet on what overnight rates are going to be 2 years from now. So easiest way to understand it, long-term bets on short-term rates. The Eurodollar futures curve is inverted. Again, normally sloping at the short end, and then it goes inverted, steeply inverted. So that's telling you that not only does the treasury market think 10-year note yield to maturities are going to be lower 2 years from now than they are today, but the Eurodollar futures market is telling you overnight rates, the rates the Fed does control, are going to be lower 2 years from now than they are today. And just to make it worse, that kink, the inversion point, the inflection point, is moving in. Like we had this conversation 6 or 8 months ago, I would have said, hey, Brian, 3 years from now, the curve's inverted. Well, it's becoming in 2 years. Now the inversion starts, the inflection point is kind of January 2023.
Okay. So that's telling us.
I'll just wrap it. So the largest, most sophisticated, biggest player, real money market in the world is telling you that the Fed's going to blink, that they're going to raise rates probably through the remainder of this year, but then things are going to get so bad, they're going to have to cut rates. And that's why we can see a liquidity crisis and a very severe recession coming well in advance.
Wow. And this liquidity crisis will be worse than the mortgage crisis of 2008, potentially.
Yes, because we're talking about markets, well, for two reasons. One, we're talking about markets with a lot more leverage. Mortgages were leveraged, and everyone said, oh, there's only $1 trillion of mortgages, subprime mortgages. If there's a 20% default rate, which is sky high, a high rate is 5%. Let's just say a 20% default rate. So that's $200 billion of losses, which in real terms was less than the S&L crisis in the 1980s. So $200 billion is a big number, but we can bear it. What people didn't understand, when I say people, I'll start with Ben Bernanke, Hank Paulson, and others. What they didn't understand was that, there was $1 billion of subprime mortgages, but it was leveraged 6-to-1 in the derivatives market. So it was actually if I said $1 billion, I misspoke, $1 trillion, but it was actually $6 trillion because it was leveraged 6-to-1 in derivatives. And now 20% of $6 trillion is 1.2 trillion. Now you're talking real money. So now apply that to Eurodollar futures, which is basically shorthand for the entire global banking system. And that's much, much more leveraged than 6-to-1. So it's a bigger crisis, and it's coming our way.